love the channel and find it useful in becoming a happy retiree. Subscribe today. So the question is, what does better? Is it true that the majority of active funds are bested by their index fund counterparts? Again, some do and some don't. So a standard, but it's not nearly as one-sided as the headlines make it out to be. Standard & Poor's just did a study, highlighted in the Wall Street Journal a couple weeks ago. It says that more than 90% of actively managed large cap equity funds. So this is in one particular category, by the way, just to qualify this. In large cap equity funds, they underperform, 90% of them underperform the index over the last 15 years. Okay, wait a minute. Okay. That's a real advertisement to ditch your active funds and use index funds or use ETFs, right? On the other side of the spectrum, PIMCO and Morningstar, again, a lot of credibility behind that, show that the majority of active bond funds, so now we're talking about a different category, hence part of the confusion in this argument. So the majority of active bond funds and bond ETFs, by the way, do in fact beat their index fund counterparts. Okay, well, that's two giant companies doing these giant longitudinal studies, and they're saying different things. But remember, they're saying different things about different areas of the market. One's large cap stocks, one's bonds. The data confirms that in most bond categories, short-term bonds, high yield bonds, intermediate bonds, and the list goes on, index funds trailed their active fund counterparts over the last 1 and 3 and 5 and 7 and 10 years. Again, I'll say it again. Index funds trailed their active funds over a 1, 3, 5, 7, and 10-year period. Interestingly, 63% of these active funds and ETFs beat their passive index over the last 5 years. So that's a very different story, isn't it, from this big argument? The study goes on to say that stock or equity funds, again, they don't fare quite as well against their passive competition, but about a third of them, very different, by the way, than the S&P study, about a third of active stock funds do beat their passive competition on a 1 and a 3 and a 5 and a 7 and a 10-year basis. That's very different than the Standard & Poor's study, isn't it? Mostly due to how each study categorizes these funds that are, and there's a bunch of them that are no longer in existence. So funds will get merged together. Funds will go away. The manager will retire and he'll close up shop. Remember, an active fund is run by active people. People have lives. Lives change. They don't do it forever. They might do it for 15 or 20 or 30 years. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.